Thanks for joining us at xm.com to look at the week ahead. The upcoming week holds a barrage of central bank meetings. They will be exceptionally important as markets add to the rate cut bets moving into 2024. I'm Cristina Marujos. With me today is our lead investment analyst, Rafi Boyadjian. Rafi, let's start with the Fed meeting on Wednesday. Do you think we'll be getting any hints on potential rate cuts as markets expect them as early as March?
Well, Christina, that is a question that everybody is asking because, of course, we have this big disconnect between what the Fed is telling us and what the markets are predicting as far as the rate path is concerned in 2024. It's going to be an important meeting, this one, because although we are not anticipating any change in interest rates, I think it's almost certain that the Fed will keep rates unchanged. We will be getting the new dot plot, which will basically give us an updated view of where Fed officials see the Fed funds rate heading in 2024 and 2025. Now, last time the Fed predicted 2 rate cuts in 2024, but this was on the assumption that they would have raised rates one more time. We haven't had that final rate hike, and we are unlikely to, but we may see the Fed possibly predicting a somewhat lower rate path in 2024 than before, because we are seeing some more progress on the inflation front. The markets, though, think that there's been enough progress on inflation to warrant a very aggressive rate cutting campaign, but this is where Powell might try to push back on in his press conference, because as far as the Fed is concerned, there's still some way to go before they can be confident that the job is done. The problem with this, that even if Powell does send out a hawkish signal on Wednesday, a day earlier, we will be getting the latest CPI report. And if we were to get another weaker than expected CPI print for November, we might well see markets ignore what the Fed is going to tell us on Wednesday and then focus on the fact that inflation is coming down, and then we'll certainly be going to be getting rate cuts possibly as early as March or May. So the Fed will probably try to signal that they're not going to be cutting anytime in the first or second quarters. But if indeed the CPI numbers are encouraging, then that could possibly mean more losses for the US dollar.
The theme of the disconnect between what markets expect and the Fed has been quite prevailing in the last week. Let's cross into Europe now, Rafi. We saw inflation in the Eurozone cool off significantly. Would that be a factor in the European Central Bank's rate decision this week?
I think it's almost certainly going to be a factor, because unlike the Fed, we are seeing ECB officials, in contrast to the Fed, actually being pretty open as far as telling us that rates have peaked in the euro area, and then we might also get some sort of updated projections as well from the ECB on what's happening, or on what's changed as far as the inflation outlook is concerned, because it's really been quite a dramatic drop in the headline CPI numbers out of the euro area. I think even ECB officials have been taken by surprise by that. And of course, if Lagarde sort of endorses the view that we may start to see rates coming down in the Eurozone, possibly sometime in April or May, which is what the markets are predicting, then that could pressure the euro. The question is, of course, how far will Lagarde go as far as this dovish tilt from the ECB? But if we compare it to the US economy, the euro area is much weaker. So you could argue that a rate cut is much more warranted in the Eurozone than in the US.
And now crossing into the United Kingdom, the Bank of England has been trying to keep a balanced tone amid high inflation and slow growth. Therefore, what could we hear from policymakers when they meet on Thursday?
Yeah, the Bank of England has had a bit of a communication battle because they have been sort of giving us some mixed signals. More recently, we've been hearing a much more tougher language coming from Governor Bailey. He's clearly been trying to push back against those bets of big rate cuts in 2024. he may even, you could even say that maybe he's one of the few central bank heads that's currently sort of still standing firm on the higher for longer stance. So what we're going to get on Thursday from the Bank of England, probably they're going to keep rates unchanged. They're probably going to maintain the tightening bias, but any shifts in the language might sway the pound a little bit as far as, confirm, sort of endorsing the higher for longer monetary policy stance. But of course, we're also going to be getting flash PMIs at the end of the week as well. So there's a lot of speculation that whether or not European economies, including the UK, are headed for a recession. So those are going to be quite important, not just for sterling, but for the euro as well.
Thursday is going to be quite a busy day as the Swiss National Bank also meets that day. How can we see the franc perform?
Well, the Swiss franc has, in fact, been one of the better performing currencies of 2023. The SNB has taken markets by surprise by how hawkish they've become over the past year or two. But now inflation in Switzerland is on the way down, and there's really no need for the SNB to continue maintaining a tightening bias, because inflation in Switzerland never even really went to the double-digit levels that we saw in other economies. So markets are kind of predicting maybe we might see a rate cut coming nearer. They're even thinking that there's a 25% chance of a rate cut this month, which is unlikely. So at best, I think we might get Chairman Jordan kind of switching to a more neutral stance. So markets will probably have to wait a little bit longer for that dovish tilt. But nevertheless, the Swiss franc might come under a little bit of a pressure.
Indeed, it's going to be an exciting week. Rafi, thanks so much. This was the week ahead here at xm.com.